The best opportunity in the stock market right now, that's what I'm going to discuss. It's not the highest returning stock ever, but it's not the riskiest stock either. So I personally believe it's offering a good risk reward setup from here. And if it goes a little bit lower, then it's going to be much better. It's a stock that I went in and out of many times, and it's mainly a defensive stock. So a lot of you are worried about the S&P being overvalued and all these things. Well, this stock many times actually inverses the S&P. So whenever the S&P is going up, the stock goes down. Whenever the S&P goes down, the stock goes up. So it could be amazing for a lot of maybe traders that watch my channel, but also long-term investors, because it's an amazing company if you intend to hold it for the long term. And this company is called Pepsi. And Pepsi is a little bit of a controversial stock. I've talked about it many times. A lot of people love the stock, they just love it very much. But a lot of people hate it because they believe they cannot raise prices forever. This is the main bias, and I'm going to discuss it here in this video. But Pepsi is a very predictable stock. I went in and out of the stock many times. Now it's back at 167. It goes to like 162, 163. Then it goes to 180. When it was a matter of like 4 or 5 weeks. Then it goes back to 160, then it goes back to 180. It's been extremely predictable stock for over 2.5, 3 years. It's been the same pattern, and I made a lot of money with Pepsi, and I might do it again. 162 is the sweet spot below 165. But even here for the long term or for the short term, I think it's presenting a pretty good buying opportunity. A lot of you are familiar with Pepsi. The main reason I prefer Pepsi over Coke for the long term is because Pepsi is more diversified amongst snacks and convenient food. It's not 100% into soft drinks and beverages. It's very diversified, and this is an amazing thing to have. And that's why Pepsi has been growing much faster than Coke over the last 10 years in terms of earnings per share and revenue in general. They have brands like Gatorade. This grew 12% annual for the last 2 years. Pepsi grew 10%, Mountain Dew 8%, Doritos 16%, Cheetos 14%, Lay's 13% CAGR. That's, very high. That's pretty amazing. And that's why I like Pepsi over other kind of businesses that are comparable to it. Now, the main problem, if you're investing in Pepsi, if you're investing in Coke, in Nestle, in Hershey's, even, in any of those snacks stocks, or whatever you want to call them, convenient food stocks or whatever it is, a lot of them have been facing organic declines. They're not growing organically, they're actually decreasing organically, mainly in volume. So volume has been declining in a lot of the sweet stocks, especially now with the Ozempic stuff. A lot of the stocks like Pepsi, Coke, a lot of their products have seen a decrease in volume, and those companies typically offset the decrease in volume by massively raising prices because they have strong brands and they have pricing power. And this is what happens every time Pepsi goes down. People claim that this is it, and Pepsi can't keep raising prices forever. It's the same thing with Visa. Whenever Visa goes down, it's so predictable. People say, it's overvalued and it's not gonna grow 10% forever. It's like, I don't know what it is. It's the same thing, and you have to pay attention to it. But that's what happened with Pepsi. Frito-Lay's is down 4% on volume. You have Quaker, which is not as big of a brand for them, but it's massively declining. They had a lot of recalls, a lot of bad stuff, and it's down 17%. So in total, volume was down 2%. Now, despite volume being down 2%, the company was still able to grow earnings per share 10%. Isn't this amazing? Mainly by expanding margins, increasing prices, especially in Europe. They were able to raise prices. I believe they faced in total around 29% in increases. And in the Middle East, they were able to raise it a little bit. And they had some volume growth in the Middle East. So in total, and some buybacks too. So in total, they got 10% earnings per share, despite the company being pretty much declining in volume. It's an amazing brand. It's an amazing company. And this is the power of those brands. And a lot of you will say, yeah, the consumer is struggling and they can't keep doing it. Well, the consumer has been struggling since 2022, guys. And Pepsi keeps doing it. And they grew 10%. This is on top of a 15% quarter last year. Q2 of 2023 was 15% growth. And on top of it, they grew another 10%. That's amazing. This is like a CAGR of 12% or 13%. This is massive, much more than the company is expecting in the long term. But the best part about it, if you want to buy Pepsi here today, you don't need the company to grow earnings per share 10, 12, or 15%. All you need the company to do is to hit their own guidance. And their own guidance over the long term is high single digits EPS growth. High single digits meaning 7%, 8%, 9%. It's mostly going to be around 8%. That's the analyst. I have it between high sevens to 8%, 8.5%. I would say 8% on average is a fair bet. Maybe Pepsi could surprise us. They could grow 10, 15% again. That would be a plus. But if they can grow 8%, this is alone, it's going to give you a return of the S&P 500, which is around 8%. You're going to get it from Pepsi by the company growing 8% in earnings every single year with branding power. And this is a recession resistant company. But you're not only getting 8% earnings per share growth that's sustainable, and it could be higher over the next 5 years, you're also getting the potential for a multiple expansion. The mean multiple over the last pretty much since 2008 for Pepsi, the mean multiple is 20 times earnings, and now it's trading at 20 times earnings. Maybe 20 times earnings isn't the cheapest thing ever. And when I bought Pepsi before, it was around 19 times. A lot of times it went to 19 times, which is around 162. This is a sweet spot again. You have to remember 162. But even here, around 20 times earnings, if you look at this chart that I'm showing you at this line, over the long term, or on a historical basis, I should say, it's been a good time to be buying Pepsi. Pepsi has many times bottomed out around this level, and it went higher from here. It went as low as 18 times, and that was in March 2020. It went to like 18 times. So now you're buying it at 20 times. I don't think it's going much lower. Maybe to 162, it could happen. It always doesn't. That would be the best. But even here, you're getting at a fair multiple. So you have the potential for a multiple expansion if we have more stimulus, and China is stimulating, and the Fed is cutting, and Europe is cutting, and all central banks are cutting, and we have stimulus 2 years from now. Maybe Pepsi could get back to 12, 13, 14% earnings per share growth. And in this case, especially if you have a declining market, it's a safety stock. Maybe Pepsi could go back to 24, 25 times earnings. So you're not only getting earnings per share of 8% growth, but you're also getting a potential of a multiple expansion from 20 times to around 23, 24 times, and you're also getting a dividend. And a dividend isn't bad at all. It's around 3.2% dividend, and they've been paying it for pretty much forever. And since 2010, the company grew at 7.7%. They've been paying it for 52 years. So what I'm looking at a company like Pepsi, with amazing brands that Gatorade and Doritos, and massive pricing power. And they did have it before. I think they're going to continue to have it. So I'm not expecting 10 to 15% like they had over the last 2 years. I'm expecting 8%. So you're getting around 8% earnings per share growth. You're getting a 3.2% dividend. And you're getting this company at the mean of 20 times with a potential of a multiple expansion. And this is a company with amazing brands, pricing power. It's a defensive company, which is very important in this market. If you're like me, and you believe the stock market is getting extended, it's getting a little bit overvalued, it's a good time to be looking at stocks like Pepsi that are falling out of favor while the AI stocks and everything else is gaining favor. The opposite will eventually happen, and Pepsi will be going back up. That's what I tend to do in this market. So I like it very much. In my opinion, it's one of the best setups in the market, the best risk reward. Now, they report earnings on Tuesday. If it goes to 162 or below 162, I'm just going to be honest, guys, I'm going to likely be buying the stock. I share what I do in my group if you're interested, but I'm mainly going to be buying it if it goes below 162. But even here, I think Pepsi is presenting good buying opportunity, one of the best risk reward setups in the market. And this was just my opinion. It wasn't financial advice. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.